Okay, so we're looking at the theoretical aspects of corporate governance. All right, so the overview that we just had about corporate governance is underpinned by certain theories. And chapter 8 is all about that, to be able to understand the theories underpinning corporate governance. Okay, so we'll be looking at agency theory, we'll look at stewardship theory, we'll look at stakeholder theory, all right? But then we'll look at the shareholder versus stakeholder approaches. That is not really a theory, but just an explanation of the concepts of shareholder and stakeholder approach. Then we'll look at other theoretical perspectives. Then we'll conclude with ethics theories and corporate governance. When we studied ethics in business, we look at the theories of ethics, and they have a role to play. Even in my explanations of overview of corporate governance, I spoke to you about the fact that the ethical aspect is meant to make you morally upright and to provide encouragement for you to do what is right. So there is a connection between ethics and corporate governance. Okay. So the theories underpinning the development of corporate governance and the areas it encompasses are, so it comes from several areas when we talk about corporate governance. So it deals with issues about finance, economics, accounting, law, management, organizational behavior, and so many other things, right? Yes, so it's about firm performance. Finance comes in there, economics is in there, management is in there. It's about keeping of financial statements and being transparent. It's about treating employees and stakeholders well, organizational behavior management. So several fields come together when we talk about the issue of corporate governance, okay, making right decisions and all that, economics and finance comes to play. So it's not just from a single field, all of these areas comes together. Okay, so we're beginning with agency theory. And if you remember our introduction to the overview of corporate governance, you will understand why the agency theory will be the first theory that we have to look at. Okay, so agency theory identifies the agency relationship where the principal, into brackets, the company's owners, delegates decision-making authority to the agent, i.e. the company's management. This theory assumes that the interests of a principal and an agent are not always in alignment, creating what is known as the agency problem. Okay, so we have the principal, who we can see are the owners who have invested money in the company. Then they have to employ other people known as the agents, i.e. the management of the company, to manage the company on their behalf. But then that can create what is known as the agency problem. Because the management aren't also the owners, they may have the appetite to waste the resources of the company. All right. And so you need to put in place mechanisms to ensure or to limit this agency problem. Okay. But there is a cost associated with that. So the expense incurred due to such objective dissonance is referred to as the agency cost. So we said one way by which we can deal with this agency problem is to have board of directors. Okay. And then additionally, you may have to pay auditors, external auditors specifically, to come and check the activities of this company. Okay, all of that is because you want to deal with this agency problem. So the cost that is associated with solving the agency problem is what is known as the agency cost. The directors will not just do those works for free. Okay, if they are doing it for free, probably we are talking about an NGO or some small SME. But if it is a well-established company, directors are paid very huge compensations and sitting allowances and so on and so forth for them to be able to carry out their work well. So it comes with a cost. Okay. So two main methods for lowering agency expenses include fair and accurate financial disclosures. So if you can get the company to disclose, keep fair and accurate financial statements and disclose same, then you can limit the number of board members and so on and so forth in order to limit your agency expenses. Okay. But how can you tell? You can never tell until you have the board even in place to check that. So 2 is to have an efficient and independent board of directors. Okay, I think we spoke a lot about this. If you don't have an efficient and especially independent board of directors, they are likely to make the matter worse. Okay, because first and foremost, they will take their own honorariums and their allowances and perks, and at the same time will allow the waste to occur. Okay, so you need an efficient and independent board of directors in order to ensure that this agency problem is minimized. So that is that for the agency theory. It basically argues that your management cannot be trusted. And so you need to put in place mechanisms to check this management, which the theory will refer to as agents, to ensure that they act in the best interest of principal, who are the shareholders in the context of a company. Okay. So all the things that we know about corporate governance actually emanate from that particular theory. The fact that you need board of directors, the fact that you need auditors, the fact that you need rules and regulations, right? All of that is based on the assumption that management of a company cannot be trusted, and there must be some checks and balances in place to ensure that they work in the best interest of the shareholders of the company. Okay. Then we have this second theory known as the stewardship theory. Don't forget the first one is known as agency theory. Okay, so they are coming from 2 keywords. So the first one is agent, and we have the next one being a steward. Okay, so the understanding of an agent is not the same as a steward. All right, normally stewards are known for their service. Stewards are not in for money or for profit, but they basically want to serve. So that is where this theory is coming from. So managers are regarded as stewards of the company's assets and will be predisposed to act in the best interest of the shareholders. So whilst agency theory sees management as agents that may steal and waste the resources of the company, the stewardship theory sees management or managers as stewards, okay, who will be predisposed to act in the best interest of shareholders. In other words, there is no need to be worried to have board of directors in place, to appoint external auditors, to have rules and regulations, to have checks and balances. No, you can trust management, all right, because they are stewards to act in the best interest of companies. Okay, so and in academia, you have to understand how theories play. A theory will be seeking to push its own position. It doesn't mean that position is right or wrong. It is basically what that theory seeks to, the position that theory seeks to highlight. So the argument from the stewardship theory is that really is actually the waste to invest in all the other mechanisms that we spoke about in terms of ensuring that companies are governed well, because management can be trusted. Okay, so stewardship theory explained that managers are not motivated by personal goals, but rather as stewards align their motives with the objectives of their principals. Okay, so that is the argument of the theory, that managers will align their interest with that of the principal, instead of the earlier points by agency theory that they may have a different intention from the principals of the company. Given a choice between self-serving and pro-organizational behavior, a steward's behavior will not depart from the interests of the organization. So basically the same thing. If they are given a choice to either please themselves or to work in the best interest of the company, they are likely to choose the interests of the company. Okay. Then, so based on this, the theory argues that control can be potentially counterproductive. So if we assume this theory is right, then why waste money paying board of directors, paying directors, whatever, external auditors, which other agents, making sure that your company comply with, say, international accounting standards and so on and so forth. That waste is considered as counterproductive according to this theory. Okay. So it's almost the opposite. It counters the position of the agency theory as we saw much earlier. Okay. So we have shareholder versus stakeholder approach. And I think we've explained this over and over again. So with shareholder approach, companies tend to have smaller obligations. So basically, their obligation under this approach is to maximize wealth for shareholders and also to comply with the law. So once they are complying with the law and making profits for their shareholders, the company is being managed well. Okay. But stakeholder approach goes beyond that. The reason why a company exists, according to this approach, is not just to make money for the shareholder, but there are other stakeholders, people that have an interest in the company whose interest must be protected. So we have employees, we have government, we have society, and several other stakeholders that must be catered for by a company. Okay. So the stakeholder theory then sees a company as an input-output model. What that means is that you need the society, you need several stakeholders, okay, to get your production or your service or your organization going. So if you look at organization, typically, they need raw materials, right? Coming from suppliers. If you extend it, the suppliers will get it from farmers, or depend upon what type of input, it may be coming from the natural environment. Companies have to rely on employees to be able to work on these raw materials and convert them to finished products. After that has been done, companies need customers to buy these products and services. So everything about the company, they are actually getting it from society or some stakeholders from society. The import of this is that once you're getting everything from these stakeholders, the output is also you should take into consideration of the interest of all the stakeholders that helped you in providing you with the input that you needed for your production. Okay. If it is financing, you have to go to the bank to get the money. The question is, who are the people who save with the bank for them to be able to give you that loan? It's coming from society. Okay, so once you're getting your input from stakeholders or society as a whole, the benefits that come from that should not just be about satisfying the interests of your shareholders, but you should be looking at the stakeholder approach. And that is where the stakeholder theory is coming from. Okay, so the management of a company should incorporate all interest groups, including employees, consumers, dealers, the government, and society. All right, so to them, proper governance means not just making value for your shareholders, but also addressing the needs of all stakeholders of the company. Okay, so that is the main thrust of this particular theory. All right. There are some criticisms to this particular theory. So the first one is, who exactly makes up a true stakeholder? So if you argue that the company should cater for the interests of other stakeholders besides the shareholders, the question is, where do we draw the line? Okay, because as I've just demonstrated, if we leave it open, then when the company makes profit, they have to share it to the whole of Ghana. Okay, because by extension, everybody in Ghana is contributing to the welfare of the company. They get their natural materials from the natural environment. Farmers have to work on their farmlands to get this natural input for the company. they get money from the banks. It is the people, the community that have to contribute to the banks. They sell to almost everybody. And so if you claim that the true or proper management of the company is about addressing the needs of shareholders, the question is who makes up the shareholders? We just limit it to customers or customers and employees, customers and employees and government. Okay. What about environmental activists? People who are interested in how the environment is kept. What do we do to them? What about the media? And so there are several stakeholders. So we need to draw a line. Otherwise, all the resources of the company will be dissipated in their bid to be able to address the needs of the several stakeholders of a company. Okay. The theory is also criticized for opening up a path to corruption. All right. What it means is that to this theory, as long as you are catering for the needs of other stakeholders beyond the shareholders, that is proper management. Okay. But the criticism is that this idea of dealing and catering for the needs of other stakeholders will become an opportunity for management to waste and probably steal or corrupt, to engage in corrupt practices. Okay. So you said they can donate to charity, right? Even the charity, who defines what type of charity or cause the company should support and what type they shouldn't support? Okay. What about going into an agreement with, say, an NGO or wherever they want to do the donation, and then have a cut of whatever will be donated to that particular organization? All right. Because when it gets to this CSR and making donations, the accountability is not there. Once you make the donation, you just record it in your books and that's it. But what really goes on behind closed doors for the management to agree that we'll sponsor this program, will not sponsor that, will fund this project, will not do that. So it gives room for corruption because then they are protected. You said we should do donations and we've done donations. So that protection can cover them, but behind closed doors, they can use the same channel to corrupt themselves. Okay. Some critics also refer to the theory as superfluous. Okay, superfluous because the shareholders themselves are key stakeholders in the company. Okay, so the argument is that once you serve the interest of shareholders, they are also members of the community. They are also part of society. Some of your shareholders could also be your customers. They could also be your suppliers. And so this idea of dealing with all or addressing the needs of all stakeholders is actually superfluous. It's not necessary. Once you cater for the interest of your shareholders, that should be enough. In fact, if you pay or address the needs of your shareholders well, they have families, right? And they will then be able to take care of their families, and that is seen to be responsible enough. Okay, so that is another criticism against this theory. Any question? Any contribution so far? So we've looked at 3 theories so far. We've looked at agency theory. The key word is agents, and therefore how to treat them. Agents cannot be trusted. We've looked at stewardship theory, and the key word there is stewards. Stewards are not agents. The stewards serve in the best interest of their masters. Okay. Then we are now on stakeholder theory. But before we go to that theory, we needed to understand shareholder approach to managing a company and stakeholder approach to managing a company. So stakeholder theory basically argues that for proper corporate governance, management should be looking at the stakeholder approach. Okay. And we've seen some criticisms against that particular theory. All right. We move to another theory known as sociological theory. Okay. So if you remember, when we're discussing the issues in corporate governance, we got to somewhere where we're talking about the composition. all right, how boards should be composed. And I was talking about gender issues, how many female and male should be part of the board, okay? So it's coming from this theory, sociological theory. So this theory looks at board composition and its implications for distribution of power and wealth in society. Okay, so the theory basically is looking at sociology is about the various groups in society, the minority groups, and so and how to treat them to make sure that we have a fair society. So it argues largely in favor of making sure that there will be female representation on board in order to check the power dynamics between the male and female, or between men and women. Okay, so that is that. So this theory largely contributes to indicators or factors that must be considered in board composition. Okay, look at female, they should be represented. Look at minority groups, they should find a way to be represented on boards in order to ensure that we have a fair society. Okay. And we have what is known as the resource dependency theory. Okay. So this theory views board of directors as being an important resource to a company. All right. Why? Because directors can be considered to be insiders. What it means is that some of them have... Hello. Some of these directors are likely to be on the boards or management of other companies. So they are industry insiders. They will actually know what is going on in the industry and are likely to bring a lot of expertise to bear or knowledge to bear in decision making. So it's similar to this point, all right? Okay, they are business experts. They have knowledge in the management of companies. They are support specialists. Okay, assuming you have, say, a banker on your board. Okay, when it comes to how to get a loan, the requirements for meeting the loan criteria, they are likely to have that expertise. If you have a lawyer and the issue is about legalities or legal matter, the lawyer can bring his expertise and advice to bear. Okay. Then some of these board directors have influence in community. Okay, community influentials. All right. They are key players, renowned people, such that whatever they say, the community is likely to go by that. And you need those kinds of people. They tend to have an influence. Okay, some people will buy from the company because they know that person is part of the directors of the company. Some investors may want to invest because they know that person is on the board of the company. Okay. In Ghana, Ishmael Youngson has that reputation a lot, okay, because of his business knowledge. So for most investors, they'll be going through the list of directors of the company to see whether they can find his name. Okay, once it's there, they have some level of confidence that that company will be managed well. All right, so that is just an example of this community influential thing. So the key thrust of this theory is that board of directors can be viewed as important resource that can help an organization to perform very well. And therefore, you need to set up this board of directors, or you need this board of directors in your company. Okay. Then we have the transaction cost theory. All right. So transaction cost theory argues that an organization which has a reasonable, efficient hierarchical structure has a foundation for managing its contractual ties. So basically, it sees like a stewardship theory, but this one is from the perspective of cost. It sees a lot of the corporate governance mechanisms and structures as waste of resources. Okay. And basically argues that if you have good management team and structure in place in an organization, you don't have to spend a lot of money, cost, okay, in getting, say, independent and effective board of directors in place and employing the services of auditors and so on and so forth. So the transaction cost theory says that if you have the right managerial and hierarchical organizational structure and system in place, you will be able to limit your cost or reduce your cost as far as the governance of organizations are concerned. All right. So like the moral, whatever, stewardship theory, it is not so much in favor with investing in a lot of corporate governance structures, but it believes that you should rather have good management structures and management structures in place, okay, in your organization. Once you have that, the organization will be managed properly and you don't have to waste money on governance structures. Okay. Then we have the moral hazard theory. That goes in line with the agency theory. All right. So moral hazard theory describes managers as having opportunistic behavior. So opportunistic, it means if they get any opportunity, they may abuse the resources of the company. Okay. Managers exhibit opportunistic behavior by making decisions that are not always in line with shareholders' interest. So from the perspective of this theory also, just like the agency theory, it will be important to have good and strong corporate governance systems and structures and mechanisms in place in order to ensure proper governance of companies. Okay. Then we have the political theory. All right. I think it was in strategic management. I was teaching some oil and gas master students, and we're talking about the external environment. I think, yes, you guys do strategy as well. Okay. The political environment is something you cannot discount if you want to manage your company well. So that's where the political theory is coming from. Okay. So the theory highlights the power of political influence over corporate governance. The political model emphasizes how government influences how corporate power, profits, and advantages are distributed. So if you want to ensure proper governance, you cannot discount political influence. Okay. Some could be coming from government of the day or politics generally as we know it. But some political influence could be coming from, say, majority and minority shareholders, all right? It's all about influence and power play when we're talking about politics. But as a good manager, you must know that there can be political influence in how companies are governed. And in Ghana, from the political landscape is quite clear, it's quite manifest. It's not just even majority and minority shareholder dynamics, but from the executive and the decisions that they take, they can have a major impact in the way companies are governed. So that is a contribution of the political theory. Okay. So you remember somewhere managerial, was it obligations to society? We said you should be politically non-aligned. All right. It's because of distance. If you become known as a member of a particular party, then be prepared when the other party comes into power. You can suffer a lot from that. Okay, so be mindful of political influence in the way you're governing your company. One law will make all your governance structures go waste. Okay. Then finally, we've spoken about this, that there is a link between ethics or ethics theory and corporate governance. The whole idea behind the theories of ethics is for you to be ethical. And once you are ethical, all things being equal, you'll be able to take or make the right business decisions. So there is a connection. All right. For example, virtue ethics argues that once you are a good person, all things being equal, you make good decisions. Okay. So in governance also, we will assume that if you're a morally upright person, you eschew corruption and producing, say, inferior products and offering inferior services to your customers. So there's a connection between being ethical and being able to manage companies well. Okay. Any questions? Any questions? So that is that for this particular topic. We're looking at the theories of ethics. So if we looked at the agency theory, stewardship theory, stakeholder theory. The other theories we looked at were resource dependency theory, which argues that directors are a key resource to a company because they come with a lot of expertise, insider information, influence that can help the company to do well. Okay, we looked at moral hazard theory, and it's similar to agency theory. All right, moral hazard says that no, we cannot trust management, and so we need to put systems in place to make sure that they don't abuse their resources that shareholders have invested in the company. Okay, then we looked at transaction cost theory. And the main thrust of the theory is that if you have your company well structured and managed, you will not need a lot of the governance structures because it becomes extra waste and cost to the company. Okay, we have sociological theory that basically was talking about the composition of board and the fact that you need minority groups, be it in terms of gender or in terms of shareholders, to be part of the board of the company to ensure fair representation. Okay, right. So that is that for this particular topic. Any questions? Are you clear? Once you are quite like this, I assume everything is okay.